James turned 41 in March. He's a project manager at a logistics company in Denver. He earns $87,000 a year. He is not in crisis. His bills are paid. His life, from the outside, looks completely fine. But last autumn, he sat down and did something most people never do. He looked back at the financial decisions he had made across his 30s and calculated what they actually cost him, not what they cost at the time, what they cost in total, what each decision compounded into across 10 years. The number he arrived at was $340,000. That is the approximate amount by which his net worth today is lower than it would have been if he had made 10 different decisions. Not dramatic decisions, not sacrificial ones. 10 decisions that, at the moment he made them, felt either responsible or simply unremarkable. Decisions that blended into the background of ordinary financial life and quietly extracted an enormous sum while drawing almost no attention to themselves. James is not telling you this as a confession. He is telling you this as a warning, because he is fairly certain that you are making at least 3 of these right now. Here are all 10. Decision 1. Buying a new car when a 3-year-old model does the same job for 40% less. A new car loses approximately 20% of its value in the first year. By the end of year 3, it has lost around half its original price. This is not a secret. It is published automotive industry data. And yet, the new car remains one of the most common and most expensive financial decisions ordinary people make repeatedly. A new mid-size car in 2026 costs approximately $48,000. The same model, 3 years old with 30,000 miles, costs approximately $28,000. The car performs identically for every practical purpose. The commute is the same length, the coffee holder is in the same place, the depreciation curve on the used model is significantly flatter. The 10-year cost of buying new rather than buying 3-year-old, the immediate loss of $20,000 in avoided depreciation, plus the financing cost on the higher purchase price, plus the higher insurance premium on a newer vehicle. Invested at 8% over 10 years instead, approximately $49,000. James bought a new car at 31. He financed it over 5 years. By the time he paid it off, the car was worth $14,000. He had paid $52,000 for something worth $14,000. The math had been visible the entire time. He had not looked at it. Decision 2. Not maxing the employer pension match because the paycheck felt thin. This is the most expensive item on this list for most people in their 20s and early 30s, and it is the one that generates the most resistance, because the logic for not doing it always feels reasonable in the moment. The average American leaves $2,954 every year by not capturing their full employer 401k match. The personal savings rate has fallen to 3.7% in Q1 2026. Tight household budgets fuel the hesitation. When a family is one unexpected car repair away from high-interest debt, moving more cash into a locked retirement account feels riskier than the cold hard math suggests it should. Here is the cold hard math. A 3% employer match on a median salary of $64,220 is roughly $1,926 per year in free money, deposited only if you contribute 3% yourself. Compounded at 7% annual return over 35 years, that foregone $1,926 per year grows to roughly $266,000 at retirement. That is $266,000 from employer contributions alone, not from your own saving, from the money your employer was offering to give you that you declined to collect. A worker who contributes enough to earn $2,569 in annual employer money starting at age 30 accumulates roughly $355,000 from the match alone by 65 at a 7% return. The 10-year cost of not capturing the full match in your 20s and early 30s, conservatively $80,000 to $120,000 by the time you reach retirement, depending on salary and match formula. The cost is not visible on the paycheck. It never appears as a deduction. It simply does not exist in an account where it should have been compounding for decades. The match is free money with a 100% instant return. There is no investment available to you anywhere that replicates that return on day one. Not capturing it fully is the single most expensive passive financial decision most people make. Decision 3. Taking the mortgage your bank approved rather than the mortgage your budget supports. Banks approve mortgages based on your income. They do not approve them based on your actual monthly obligations, your career stability, your plans for children, or your need for any financial flexibility whatsoever. The approval is a ceiling, not a recommendation. The average approved mortgage in 2026 will consume between 28 and 35% of the borrower's gross income in monthly payments. After tax, insurance, maintenance, and property tax, the true housing cost for many borrowers sits between 40 and 50% of take-home pay. At that cost level, there is almost no room for anything else to go wrong. A car repair becomes a crisis. A period of reduced income becomes catastrophic. The emergency fund that should exist does not exist because the mortgage consumed the capacity to build it. The 10-year cost of taking the maximum approved mortgage rather than a conservative one, not a single round number, but the cumulative cost of the financial fragility it creates, the emergency debt incurred when the buffer did not exist, the investment contributions not made because the budget had no room, the career risk not taken because the mortgage required a stable income at all times. Conservatively, $50,000 to $100,000 in compounding opportunity cost over a decade. James took the maximum approved mortgage at 33. His bank approved $520,000. He bought at $510,000. By 36, his wife had reduced her hours after their first child, and their monthly cash flow was negative. They put $14,000 on credit cards over 8 months before things stabilized. He is still paying the interest rate premium that credit damage created. Decision 4. Not building an emergency fund before investing. The logic for skipping the emergency fund is always the same. The market is up. Investments return more than the fund would earn in a savings account. Every month without investment is a lost month of compounding. This logic is correct in a frictionless world. It is catastrophically wrong in the world where people actually live. The person who invests without an emergency fund has created a system with a single point of failure. Any unexpected expense, a medical bill, a car repair, a period of reduced income, forces them to either take on high-interest debt or liquidate investments, potentially at a loss and at a taxable moment they did not choose. The average unexpected expense that breaches the finances of a household without an emergency buffer, $2,800, according to Federal Reserve data. The average interest paid on credit card debt used to cover that expense over the period it takes to repay it, $800 to $1,400, depending on the balance and rate. The 10-year cost of never building the buffer, the cumulative interest on emergency credit card debt, the forced investment liquidations at suboptimal moments, and the compounding interruptions those liquidations create. For the average household, $15,000 to $30,000 over a decade. The emergency fund is not a conservative alternative to investing. It is the prerequisite for investing without catastrophic downside risk. Decision 5. Treating a pay rise as permission to upgrade everything simultaneously. This one has a name, lifestyle inflation, and it operates with a speed and completeness that most people only recognize in retrospect. The pay rise arrives, it is real, it is earned, it is meaningful, and within 6 to 12 months, the entire increment has been absorbed by the lifestyle it enabled. The better apartment, the newer car, the more frequent restaurants, the holiday that previously felt aspirational but now feels proportionate. None of these individually feels excessive. Collectively, they consume the raise entirely, leaving the savings rate unchanged despite the higher income. Vanguard research has consistently found that savings rates do not automatically increase with income. The percentage of income saved by a household earning $80,000 is not significantly different from the percentage saved by a household earning $120,000 because lifestyle expansion absorbs the increment at each stage. The 10-year cost of lifestyle inflation on a moderate pay rise, a household that receives a $12,000 annual raise at age 30 and spends all of it, will have an additional $120,000 of cumulative spending over a decade. If, instead, Half of that raise, $6,000 per year, is redirected to investment at 8%, approximately $92,000 after 10 years. The lifestyle difference between saving $6,000 of a raise and spending all of it is almost imperceptible in daily life. The wealth difference after 10 years is nearly $100,000. Decision 6. Staying in a high cost of living city past the point where the career premium justifies it. This one requires a calculation almost nobody makes. The premium that a high cost of living city provides is real in the early career years. The salary in New York or San Francisco or London is genuinely higher than the salary for the same role in a secondary market. The network access, the career velocity, the opportunity density, these are real advantages that compound into career capital. The question is not whether the premium exists. The question is when it stops being worth the cost. A software engineer earning $180,000 in San Francisco after rent of $3,400 per month, state income tax of approximately 9.3%, and the broader cost premium of the Bay Area, has a net financial position that is frequently indistinguishable from the same engineer earning $130,000 in Austin or Denver or Raleigh. At the early career stage, the network advantage of the expensive city justifies the cost. At the mid-career stage, when the network is established and the skills are transferable, the justification weakens considerably. The 10-year cost of staying 5 years past the justified point, the cumulative difference in disposable income between the expensive and moderate cost of living cities, which for many professionals is $15,000 to $30,000 per year, over 5 additional unnecessary years, $75,000 to $150,000 in foregone accumulation. Decision 7. Not renegotiating salary every 2 years. Salary does not increase automatically with performance. It increases when it is negotiated. This is one of the most thoroughly documented findings in labor economics, and it is one of the most consistently ignored by the people it affects most. The average pay increase received without negotiation, the standard annual review increment, is approximately 3 to 4% in a normal year. The average pay increase received when an employee has a competing offer or makes a specific, documented case for a market rate adjustment, 8 to 15%, depending on the industry and role. The compounding cost of accepting the 3% annual increment rather than negotiating to market rate every 2 years begins small and becomes significant quickly. A professional earning $65,000 at age 28 who receives only the standard increment reaches approximately $85,000 by age 38. The same professional who negotiates to market rate at 30 and 32 and 34, achieving an average of 10% every 2 years, reaches approximately $105,000 by age 38. The 10-year salary gap, approximately $20,000 per year by the end of the period. The 10-year cumulative income gap, approximately $120,000 before investment of the differential. James never once asked for a raise across his entire 30s. He received what he was given. He now calls this the single most expensive form of politeness he has ever practiced. Decision 8. Outsourcing financial decisions to a partner and losing financial literacy. This one is the quietest item on the list, and for many people, the most personally uncomfortable. In most long-term relationships, one partner becomes the de facto financial decision-maker. The other partner disengages, partially, then more completely, from the day-to-day understanding of the household's financial position. They know broadly what is coming in and going out. They do not know the investment account structure, the insurance policies, the pension arrangements, the net worth trajectory. This creates a specific vulnerability that is invisible until it is not. Divorce, death, incapacity, the sudden transfer of full financial responsibility to a person who has not held it and does not fully understand it. The decisions made from that position of ignorance carry a measurable and sometimes catastrophic cost. Beyond the emergency scenario, the person who has outsourced their financial literacy has also outsourced their financial agency. They cannot advocate for their own interests in financial decisions because they do not have the context to evaluate them. They accept recommendations they cannot assess. They miss opportunities they cannot recognize. The 10-year cost of lost financial literacy is not a single number. It is an accumulation of suboptimal decisions made without full information across a decade by someone who had delegated the understanding that would have made better decisions possible. Decision 9. Keeping money in a low-interest savings account for years because transfers feel complicated. This one is almost embarrassing in its simplicity, and it costs more people more money than almost any other item on this list. The average traditional savings account at a major U.S. bank in 2026 pays approximately 0.5% interest annually. The average high-yield savings account at an online bank pays approximately 4.5 to 5%. The difference between these two rates requires a single online application that takes 15 minutes. On a balance of $20,000 kept in a traditional savings account for 5 years, interest earned at 0.5% is approximately $500. The same balance in a high-yield account at 4.8% earns approximately $5,270 over the same period. The 10-year cost of not making the transfer on a $20,000 balance, approximately $10,000 in foregone interest. On a $50,000 balance, approximately $25,000. The money is there, the rate is there, the application is free. The only barrier is the 15 minutes that feel, for reasons nobody can quite articulate, like too much friction to overcome. James had $31,000 sitting in a standard savings account for 4 years before he moved it. The interest he forfeited, approximately $5,800. He describes the discovery as the most expensive case of mild inconvenience I have ever experienced. Decision 10. Delaying life insurance until a health event makes it expensive. Life insurance purchased at 28 in good health costs for a 20-year term policy with $500,000 in coverage approximately $25 to $35 per month. The same policy purchased at 38 after a diabetes diagnosis or elevated blood pressure costs $80 to $180 per month or becomes unavailable entirely at standard rates. The window during which life insurance is cheap is the window during which most people feel least urgency to buy it. The urgency arrives when the health event does. At that point, the window is closed. The 10-year cost of delaying for a person who develops a common health condition between 28 and 38, the premium increase on a 20-year policy is approximately $600 to $1,800 per year. Over the remaining term, $12,000 to $36,000 in additional premiums paid for identical coverage, or no coverage at all. The decision to delay is always made by someone who feels young, healthy, and in no immediate need of a product whose purpose is to protect against the thing they are currently not experiencing. It is one of the most rational feeling, irrational decisions in personal finance. James has made 7 of these 10. He is 41 years old. He has a good salary, a mortgage, and a net worth that was $340,000 lower than the one that was available to him across his 30s. He is not destitute. He is not in crisis. He is simply living in the specific financial reality created by a decade of decisions that each felt fine in isolation and accumulated into something significant across time. He is also, for the first time, making none of the remaining 3. He transferred his savings account balance to a high-yield account in November. He has since renegotiated his salary, a conversation he describes as the most uncomfortable 17 minutes of his professional life that resulted in an $11,000 annual increase. He bought a 20-year term life insurance policy in January, having not yet developed any condition that would have changed the rate. The decisions that are still open are still open. That is the only thing about regret that is worth holding on to. The ones you have not made yet, you can still make differently.